Let's start with a quick question. What do you think silver is priced at right now? If you're checking your app and seeing around $71 per ounce, you're focused on the wrong marketplace. And that's precisely the issue that's on the verge of transforming the entire precious metals landscape. Because as your trading platform displays silver at $71, dealers in Tokyo are shelling out $130 for the very same material. Sellers in Dubai are quoting similar levels. And buyers in Singapore, for industrial use, are struggling to secure any supply under $115. This unprecedented price split in precious metals isn't some short-lived glitch or local oddity. It's the final warning sign of a pricing mechanism that's rapidly detaching from actual conditions. What really demands our focus here is this. We're not dealing with varying qualities or shipping holdups. Identical 1,000-ounce bars of 99.9% pure silver are exchanging hands in several regions at almost twice the quoted paper price, all at the same time. The futures-dominated markets, responsible for setting most benchmark prices, are painting one picture. Meanwhile, the real-world physical markets, where metal actually transfers ownership, are shouting an entirely different story. Pause and consider that for a second. When have you ever seen something like bread selling for $3 a loaf in one major city and $6 in another, week after week? It simply doesn't occur in healthy markets because arbitrage wipes out discrepancies almost immediately. Buyers scoop up the lower-priced goods and ship them to higher-priced areas until equilibrium returns. That's fundamental economics we've trusted for hundreds of years. Yet silver is no longer acting like a normal, efficient market. The spread isn't narrowing, it's actually growing wider. And the underlying cause should worry anyone with retirement accounts, stock holdings, or assets tied to the US dollar. Just a few days ago, on January 1st, 2026, China rolled out the toughest silver export restrictions seen in decades. This wasn't a slow rollout or test phase. It was an abrupt licensing requirement that suddenly restricted about 65% of the world's refined silver output. Now, only 44 approved Chinese firms can export silver overseas, and they're bogged down with quotas, paperwork, and delays that make shipping silver as complicated as sending out restricted tech. To grasp the scale, China produces more refined silver than the next 5 nations put together. By essentially sealing off 2/3 of global supply virtually overnight, this isn't a small tweak. It's a complete overhaul of supply fundamentals for a vital metal used in everything from solar panels and gadgets to medical devices. Markets in the West were blindsided. Yes, there were rumors circulating in trading circles last autumn, leaked policy drafts that most experts brushed off as routine saber-rattling. But the sudden enforcement left industries scrambling. Factories in Germany, chip makers in Taiwan, and solar firms in the US are now desperately hunting for non-Chinese sources. This is where the numbers start to feel alarming. Only about 35% of refined silver now moves freely through exchanges like COMEX in New York and LBMA in London, the very places still quoting 71, while real buyers are bidding double or more. Recent COMEX reports showed deliverable registered inventory plunging to just 128 million ounces, the lowest since early 2025. And timing couldn't be worse. December saw demands for physical delivery spike to 65 million ounces. Let that sink in. In a single month, contracts called for delivery of more than half the registered stock available. Not a modest 10% bump that might raise eyebrows, not even 20% that would spark internal alerts. Over 50%. These takedowns aren't from traders flipping for quick profits. They're from factories desperate for metal they can't get elsewhere. From buyers in Asia paying Tokyo markups but taking COMEX bars as a fallback. From refiners chasing the spread between paper quotes and physical reality before it vanishes or before the system strains too far. We've all seen basic supply-demand in action. When real-world need outstrips available goods, prices climb until balance returns. It's not politics or opinion. It's pure scarcity economics, guiding trade since ancient times. But the future silver market isn't reacting normally. COMEX quotes hardly flinched as stocks dwindled and deliveries soared. How can prices remain pinned down while supply evaporates and demand explodes? Either the paper market doubts the shortage is genuine or it's fundamentally detached from tangible reality. Given the signals from Tokyo, Dubai, and Singapore, the second explanation fits best. Imagine you're running a large manufacturing plant in Europe, requiring 50 million ounces over the coming Banyan to keep lines running. You can't delay for future settlements. Your deadlines don't wait. China's doors are closed due to the new rules. So, like producers throughout history, you bid what the physical market requires. 130s, paid. 150, paid. Stopping production, idling workers, and losing ground to rivals isn't an option. Scale that up across every solar panel maker, chip fabricator, medical supplier, and industrial consumer globally facing identical shortages. They're all vying for that slim 35% of supply not locked in China. COMEX's 128 million ounces registered. That's barely enough for 2 months of worldwide industrial use. It's negligible against the hole created by China's policy. It can't possibly cover rising futures deliveries, plus physical buyers paying premium rates. Inevitably, something must break. COMEX quotes could rocket upward to match reality and eliminate the spread. Or the exchange shifts to cash-only settlements, or somehow unseen sources refill vaults. But history teaches us, when paper and physical diverge this far, physical always prevails in the end. You can't produce real goods with paper promises. Solar panels aren't built from exchange receipts. You need the actual bars. That $71 quote is surviving on temporary life support from a futures system growing more isolated from the ongoing physical crunch. When support fades and paper finally acknowledges what physical traders have known for weeks, that silver is vastly scarcer than screens suggest, the adjustment won't be smooth or measured. Expect the sort of sudden shift that upends holdings, restructures markets, and makes every portfolio owner face a hard reality. Screen prices may no longer represent true asset worth. This becomes even starker when we examine actions by major banks as the gap widens. JP Morgan didn't rise to dominate U.S. banking through impulse or crowd following. Their strength comes from rigorous risk-reward calculations, spotting imbalances early and moving boldly. So their silver moves over the last 7 months are revealing. Reports from trading sources and CFTC data suggest JP Morgan fully exited a 200 million ounce paper short position from June to October 2025. Not a trim, but total closure of a long-standing bearish bet that profited from declines. Even more telling, as they unwound shorts, they built an estimated 750 million ounce physical hoard, the biggest ever by a bank. Not contracts or synthetics, real allocated metal. The reversal is staggering, from wagering on falls to owning more silver than many nations' reserves. From gaining on weakness to primed for gains on strength. All while COMEX stayed mostly below $70. You might wonder if it's just balanced hedging. But one additional action rules that out. They leased about 129 million ounces, 4,000 tons, to a Chinese bank with mandatory return in early January 2026, exactly coinciding with China's restrictions, low COMEX stocks, and exploding Asian premiums. Think of it like loaning your snowblower in fall, demanding return midwinter just before a blizzard. If they expected stable or lower prices, why ensure maximum Western holdings precisely when shortages peak? Clues emerged from London's stress 3 months back, a story underreported but critical. In October 2025, India ordered 1,000 tons, 32 million ounces, via LBMA. Modest against claimed 844 million ounce vaults. But lease rates, borrowing costs, skyrocketed from 0.25% to over 200% in hours. Major refiner Metalor fully halted silver processing until 2026, unable to source input despite ample stocks. Like an auto plant shutting for lack of steel in a supposedly flooded market, it signals deep illiquidity. LBMA downplayed it, reiterating vault totals. But spikes happened because real delivery demands exposed cracks in the leasing web propping up paper trading. The recurring theme, big physical calls strain the system, rates explode, operations pause, premiums balloon, cash deals emerge. Yet screen prices ignore the fractures. Then, late December 2025, CME hiked silver margins 25% over holidays, low volume timing. This echoes past plays. 1980, Hunt Squeeze, and 2011 Peak both saw hikes preceding crashes to curb speculation when delivery risks rose. But unlike then, hikes after parabolic runs, today's came with prices flat near $70, no bubble evident. Why hit brakes absent frenzy? Likely because internal data on inventories, interest, and demands signal the quoted price badly misrepresents physical strain. They're preempting heavier delivery claims, aware, like JP Morgan, that paper's days are numbered. World Silver Institute data. 2025 demand outpaced supply by 200 million ounces. Fifth straight structural shortfall from industry, investment, jewelry, draining more than mines, recycling provide. Cumulative, over 1 billion ounces gone. COMEX registered 128 million. LBMA claims 844 million. We've consumed more than both hold combined in 5 years, yet prices barely budged. Sources? Likely quiet drawdowns from investor institutional stockpiles, meaning far less real silver exists than assumed. Events in London, COMEX pressures, Asian premiums point that way. JP Morgan's hoard may be among the last major Western piles outside China or industry chains. They're holding firm. At sub 100 million inventory, shortages hit 50 million plus at stress levels. Picture holding a futures contract at $71, spotting $130 physical, demanding delivery for profit, only to get cash at paper price. Rules allow it in impractical cases. Cash at low quotes while physical soars erodes trust. Users flee futures for direct buys. Paper shot physical split as assets. Decades-old system crumbles. Discovery shifts east. JP Morgan gets this. Their conservative $56 2026 forecast assumes status quo, all crumbling now. Restrictions lock 170 million ounces yearly from West. Sources: raid stockpiles, boost recycling, substitute where possible, drive prices up for balance. But industrial need is rigid. No solar without silver paste, chips without conductors. Firms absorb costs, pass on. Investment too. Premium recognition, cash settle fears, big player piles accelerate buys. 2026 projections: 650 million industrial alone versus an R1 billion total supply. Tight before restrictions. Sixth deficit year, 1 billion cumulative drain as industry consumes irreversibly. Now, depleted stocks, plus restricted inflow, plus surging calls, dose inevitable. COMEX surges to physical, or admits limits and cedes dominance. No magic refill. January 15th, rebalance adds pressure. Funds liquidate futures, potentially depressing paper, while physical holds firm, widening gaps, hastening demands. JP Morgan prepped for this. Hoarding, closing shorts, recalling. Timing unknown, February failures, spring peaks, or managed muddle. But no compressing premiums without explaining Western access amid controls, deficits, growth. Repricing comes from math, not emotion. Unsustainable leverage, obvious arbitrage, restricted supply force. Tokyo, $130 is the emerging standard as paper yields or fades when it aligns. Portfolios, budgets, positions revalue on real scarcity. Banks, China, industry positioned. Question: not if repriced, physical already is, but when paper admits since January 1st. Adjustment, sudden, violent, reshaping overnight. Math clear, signals obvious, clock ticking. Biggest precious metals split nears resolution, ready or not.